Hi, this is Randy Finney with the right side of the chart, and today is Wednesday, June 13th, 2018. We have the FOMC announcement today at 2 o'clock Eastern Time, and again, it's not about the what they do with rates. We all know it's going to be a quarter point rate hike. Nothing more, nothing less, 95% plus probability of that, according to the Fed Fund futures. What's more important is what they say afterwards that may indicate any change in the trajectory of expected future rates. So let's take a look here at the charts. Let's see what we have developing here. The S&P 500, this is the ES, E-mini futures. We don't really have much of a change. We continue to work our way higher. I had this previous trend line here in blue, which we broke down. That one was somewhat well defined, not great. I guess I had it right about here, a couple reactions, so a little breakdown. But this is now the trend line, which has since evolved with that reaction low. So as you can see, going back to June 29th, we have one reaction. That's where the trend line generates from. And a couple reactions so far, and we continue to diverge as we move higher. So in other words, we have not taken out the divergences that were in place here. We had a little correction there off that divergent high, and you can see on all the indicators below, the PPO, MACD, RSI, as we continue to wedge higher here, we're walking this trend line now. So something to watch for today. That could break of that trend line, especially a 60-minute close below it, could trigger near-term pullback. And if we come back down, swing target right here, my minimum target here is about 2739, call it 2740 on ES. Again, these are S&P 500 futures. We'll get to QQQ and SPY in just a second. As far as NQ, the Nasdaq 100 E-mini futures go, also a 60-minute time frame. We had this minor price channel here. Again, this is all stuff that was highlighted in the past. We broke down, made an impulsive move down, had a reaction off this trend line, which I was labeling as a primary trend line, this being a minor trend line. So here's at least on our 60-minute time frame. Keep in mind, time frames and these moves that I'm expecting are commensurate with the time frames we're talking about. This isn't a daily time frame or a weekly. So this is just near-term stuff for swing traders, active traders. So there it is. We had a reaction there, overshot it. That's what I call a momentum-fueled overshoot. This little brief spike below, had our reaction, then gave up that line, moved down impulsively. And as you can see here, we've been back testing it from below since. So that's the same trend line highlighted, back here before we even broke down from this little minor channel. And we've been back testing, and now we've set up another minor trend line right here to watch. And so just as with SPY, we have not even come close to taking out the divergences yet. So we have now larger divergences in place going back from here. You can see the PPO, MACD, RSI all continuing to make lower highs as prices go on to make higher highs. So that's something to watch. And then pullback targets as far as NQ goes, we're looking at about 70.12 would be my minimum swing target if and when this minor trend line breaks. And again, look for both a breakdown in the ES or SPY if you're a SPY trader, as well as QQQ or NQ. You want to see them both break down. You want to see impulsive selling to help confirm a breakdown, and ideally a 60-minute candlestick close below those levels. So that's what we're looking at here on the futures. And again, this is all near-term stuff. Now, before I move too much forward, I want to just back up for a second and say that over the years, been trading many years, and it is not just unusual; it's more of the norm during a FOMC day. You see the markets sort of hold up right up until the meeting. Volatility has been relatively low. We had some intraday price swings, but the daily moves, you look at the daily candles on SPY, they're almost non-existent recently. They're so small. But where I'm going with this is after the FOMC announcement, you're very likely to see a rip in either direction. Could be the initial rip could be to the downside or to the upside. And I tend to stand aside during FOMC days, especially in the wake in the first hour or so, or even all day today, because it's not unusual to see the initial rip or dip, whatever that reaction is to the announcement, get faded in the opposite direction. Then sometimes even that rip that comes afterwards gets faded once again. So expect that afterwards. And where it comes into play too, if you're swing trading and you have any positions close to a price target, I like to let it go. If you're targeting a certain level on a trade that you're profitable in, let that volatility work in your advantage to get to that price target. In other words, leave your sell limit order in place, or if you're short, your buy to cover limit. And if you are long, you want to maybe consider pulling your stops if they're really close, because in that post FOMC noise, I call it, um, you get those back and forth swings, and what it can do is it can run your stops. But again, I use that to my advantage. If I'm close to a price target, let it hit that target, whereas I might temporarily suspend stops and wait and see how the dust settles and how we trade until tomorrow through the end of the week and into early next week. So that's what I'm watching for here. Nothing's changed on my view. Yes, we've walked higher, but again, these divergences are in place. There's some pretty clear uptrend lines. So we don't have anything close to a sell signal yet, but we're not far from it. And again, just watch for impulsive selling afterwards if those levels go. One more thing, I have to jump back to ES. I wanted to make mention. You can probably see some blue lines here, three horizontal lines. When I zoom back a little bit, these are all reactions. You can see reactions here going back to March on the March highs, and that's what we're testing right now. So reaction highs are often areas of resistance. So that's what the SPY is up against now. In fact, we're right here. This is where these trend lines start. So we had this reaction in late February 1st. And then those are the March, early mid-March reaction highs, and that's what the S&P is up against. And then beyond that, you have the all-time highs back here in late January, still yet to be taken out on the SPY. And okay, comparable levels for you SPY traders. You can see again over here, those are the the mid March highs, reaction highs. That was our last official swing trade on SPY where we hit that final target, got out just in time before that big drop. And now we're looking at this potential. Here's an uptrend line, which on SPY is already cracked. And guys, again, this is why I look at the futures. The futures will paint a different technical picture because they trade virtually around the clock. So that's why I like to watch both. And you always give like to give the benefit of a doubt. If the trend is currently up, which it is, you want to see confirmation on breakdowns. In other words, if I'm looking at two different trend lines on SPY, like I am right now, and ES, the E-minis, I'll wait till the last of the two break for additional confirmation, and I'll also wait for the Nasdaq futures to break down, because I've seen it so many times where one of the two indices breaks a well-watched support level, the other doesn't, and then the trend continues in the direction it was already going. So, you got to give it the benefit of the doubt and wait for all those trend lines to go on both these the index tracking ETFs, as well as the futures. And so what we have here, and I mentioned this the other day, here's a trend line on SPY, but when it broke down, and I said this yesterday, I think it was, that it was not impulsive at all, and we're in front of the Fed. So there were two reasons, I mentioned that in the trading room, two reasons why I wouldn't short a breakdown of this is, again, the fact it was not any impulsive selling afterwards to confirm the validity of that trend line or the breakdown, and nothing big is going to happen in front of the Fed. As you can see here, the market is, as I've been saying for a week, we'll go into a holding pattern in front of the FOMC, and that's what it's done. You can see this, the bias has been upwards for the last pretty much most of this month, or all of this month, but mostly sideways recently as traders are waiting to hear what the Fed says. So there it is. Again, don't try to read too much into it, but you can see the negative divergences in place here as well as we come up and test that previous reaction high, and then QQQ. I have a couple different variations here on the Q 60-minute chart. You can see this is the trend line to watch. We have quite a few reactions. This trend line comes off the late April, it looks like April 25th lows. We have a reaction, second reaction, third reaction, and we have this minor trend line right here, this white trend line to watch. So that would probably mesh with what I was looking at a minute ago on NQ. You can see that we continue to wedge higher here. We had divergences recently at this high, and these divergences are now starting to steepen. This is just an extension right here of these existing divergences. And you can see as prices thrust up, make a new high, now we're really seeing the indicators lag. But as I often mention, the one of the best trend indicators out there, in my opinion, is this 9 EMA. Look at the signal line on the PPO, and when it is, and that's that white dotted line, not the blue line. When it's above zero, the trend is bullish, and when it's below zero, the trend is bearish. It's as simple as that. Nothing's perfect, but it's about as good as it gets for a trend indicator. So it's telling us the trend is bullish now. However, if we break this, that would be an early indication. That would probably bring us down here to this yellow uptrend line. And then if we break that yellow uptrend line, especially if it's followed by impulsive selling, look for these minimum targets right here. I think we come down to 166.85. This is what I call my preferred swing target. If we start to see some, downward momentum after the FOMC announcement, that's where I would look if you're looking for a quick pullback trade, or if you're a long looking to buy a dip on any possible post FOMC weakness in the market. I think that 166.85 level is a nice target to watch. And of course, if that starts to play out, you can see we're not far above that zero line. That would also put us back into a bearish, start to flip these trend indicators to a sell signal there. One other chart I wanted to hit on real quick is I've noticed, and it's a little too early to really declare it as a trend or anything other than a temporary disconnect, but something I'm continuing to monitor. I'm noticing finally weakness in the tech stocks. Now, what I've done here, this is a 60-minute chart. I just flipped over from, instead of candlesticks, the green and red line below is QQQ. So we're looking at QQQ, the green and red, and then I overlaid XLK in white. And as you guys heard me, if you followed me for a while, you've heard me say this many times over. The QQQ is technically or basically, and I joke around, a tech fund with an Amazon kicker. Yes, there's more than just technology and Amazon in there, but it's so overweighted in technology and Amazon that you can overlay the two. If you don't believe me, go back as far as you want, and you will see a near perfect mirror of XLK, which is the technology ETF, and QQQ, and you can see it here on a 60-minute chart. This goes back to early March, the beginning of March, March 1st there. The white line and the green red line overlay almost perfectly. So what I'm getting at is zooming in closely, and you can see here some recent divergence about this point starting back just a couple days ago. We're really seeing tech start to underperform right now, and tech is the market. Make no mistake about it. It is by far the largest component of the Nasdaq 100. It's also by far the largest component of the S&P 500. That's what's lifted this market. That's what continues to carry this market. Maybe the rest of the market's playing a game of catch up, maybe not. But that segues into my next discussion here, which is looking at some of the sector rotation we're seeing right now. Okay, what I wanted to look at is the performance of the S&P 500, the broad market, compared to the defensive sectors, I should say, in the economy. So what you have on this chart is in white. You can see up top the S&P 500 or SPY is in white. XLU is in blue. XLU, by the way, is utility ETF. XLP, consumer staples, is in orange. XLV, healthcare sector ETF, is in yellow, and then IWire in purple. And so you can see this I picked a random point here. We know the market's been moving higher from, really been in an uptrend for a while now, and you can see the S&P 500, which is heavy with technology, has outperformed these defensive sectors, and that's because the economy has been growing, the stock market's been going up, and so the defensive sectors are out of favor. Defensive, by the way, just means when the economy turns down or the smart money institutions foresee a turn down, they start moving money into defensive sectors and out of high growth sectors like technology. So you can see here clearly that defense sectors have lagged. But now when we zoom in, I'm scrolling forward to just taking a look at what's going on recently. And let's go back. What are we at? We're on June 13th. So we're about 2 weeks into the month. So let's just go back to around the beginning of the month here. If I can do that, I have to put all the lines start at equal points. There it is. So you can see so far, especially in recent days here, I'll zoom in a little bit. In about the last week or so, you can see a pretty good outperformance in consumer staples, which I mentioned. I did a video on the sector recently. It stood out to me, and so we had a big pop. Since then, a lot of those stocks started to move. You can see utilities outperforming. Again, the white line is the S&P 500. The only thing, and it was outperforming, were the REITs. Now, there's a little flaw with this analysis. Um, Not all REITs are considered defensive issues. For example, we have some in IYR, which is one of various REITs, ETFs. You have a lot of retail operators like Simon Property Group. That's a trade idea I mentioned I really liked a few weeks back. It's been doing really well. A lot of retailers have been doing well. So unfortunately, I couldn't find the type of REITs that are defensive are apartment REITs. Why? Because during a recession or a downturn in the economy, people walk on their houses or they don't buy new houses because things are tight. So the apartment rentals actually go up and do well. Healthcare REITs, hospitals, doctors' offices, things related to the healthcare industry, those are recession proof. So those tend to do well. So again, it's not a perfect analogy because I couldn't find a pure apartment REIT ETF, and maybe there's one out there. There's certainly a lot of stocks, and I can see they've done well recently. So I just wanted to point that out. So for the most part, you have all the defensive issues recently. Now, is that a trend? It's been a week or so. Maybe, maybe not, but it does show some sector rotation recently into the defensive issues, and I also showed you a little bit of underperformance by technology, and that's a first, at least for a while now. And let's just look at those sectors again. IYR, I started making a case, bullish case on the REITs back here, and they've had a heck of a run. So the recent underperformance, I should say, is mostly really today with this big red candle. But the REITs have been stretched. They've had a heck of a run. Here's that SPG I mentioned, already coming up on the fourth and final target. I like this one back here with the divergent low. That was one of my top picks in the sector, and that's again, this is a retailer, so. They own the largest, at least over the years, they have been the largest mall operator. I haven't read up on them recently. I don't know if anybody overtook them, but I don't believe so. So there's Simon. And again, XLP I mentioned recently, and really nice and big move. So that's what I'm trying to get at here is I just wanted to point out, a few days or a few weeks doesn't make a trend. We've seen a little uptick in utilities recently. And you want to watch that. You want to see if we see additional, keep an eye out, I should say, if we see additional rotation into defensive sectors. And let's see what else we want to cover before we wrap this. Here's treasury bonds. I still like treasuries. I still think at the very least, it's not a get rich quick opportunity. Doing this enough years and even going back to my former life as a financial advisor, I'll never forget the dot-com days in the late 90s, having clients come into the office and they were upset because their blue chip stock fund was only up 23% or their bond portfolio was, their bond portion of their, portfolio was lagging, and they're aggressive. Their Nasdaq and growth funds were up 100% year to date in 1999. And again, it's all part of asset allocation. Yeah, and treasuries again are not a way to get rich quick, but it does make for a well-rounded, diversified portfolio, and you're getting paid to wait. So there's TLT, and of course IEF, the other. Still an official trade idea, still paying us. We've had several dividends paid out since we've been in this one, so our cost basis, we're profitable on the trade, and it's still backtesting that trend line. So let's see what happens after the FOMC meeting today. Most likely over the next week or so, we'll get a good cue on where bonds are going based on what the Fed says. And remember, guys, it's not all about the Fed too. The ECB, Bank of Japan, they've been behind the curve. We've been the one raising rates. Our economy has been the strongest. And there is talk now of those other central banks starting to taper off. So remember, the dollar doesn't exist in a vacuum. The US dollar index is the dollar compared relative to other currencies, the euro by far being the largest, the yen the second largest. So you want to watch for what goes on there. In other words, we could raise rates. The Fed could say we're going to continue to raise. But all of a sudden, the ECB comes in and says, we're going to start backing off our easy money policy. We're going to start tapering as well. Things like that can actually bring the dollar down, even if our rates continue to go up. But if Europe and Japan or the Euro Union, they go up more than we do, then the dollar will fall. And also at times it's just the market's expectation of what may happen, not what actually happens. Keep that in mind as well. Here's gold. Nothing new to add to gold. I can't really, for weeks I've been saying we're here. We're at uptrend line support. Gold has been extremely resilient. It's not going up, but it's not going down either. In fact, it's going up, a little bit. It's walking up this trend line, but there it is. It's at a somewhat precarious technical position. I have to say that. Trend indicator, the PPO signal line's below the zero line right now, and we're sitting right on trend line support. Possibly a break below there. This market is full of trickery, so it would not surprise me in the least to see a temporary breakdown 1, 2, 3 days below this trend line, maybe even in the wake of the FOMC meeting today or announcement, and then recover that trend line. So longer term, I remain bullish on gold and the miners, but we have to watch this. If we break down and it's more than that, we start getting having impulsive selling, maybe a breakdown to back test, that does change the technical outlook. But again, I'll also take a look at the dollar index, and I still think the dollar looks poised to move lower in the coming months here. Okay, we'll wrap this video. I wanted to really, what I did up until now is cover, just update most everything I covered in the last video, the sectors and things in the market that stood out to me. And again, we'll see what happens after today. That everything could change in the next couple days here after the FOMC announcement. But again, I don't expect huge fireworks because we already know what we're going to get as far as what the rate is. And in my view on the Fed, no matter what they say, it's not what they're going to do. They come out and they say this, they say that. The Fed is reactive, not so they're going to wait. And if they tell you right now they plan to do X, Y, Z going forward, and market conditions change, they will not do. They'll do ABC. So that's one thing I've learned about the Fed. But again, I don't control the market, so we'll have to pay attention to what the market thinks about what their comments are today. Where I wanted to wrap this video up is one sector that I've been highlighting via a couple individual stocks in the trading room recently. We are now at support. This is the specialty and generic drug manufacturer, so a subset, if you will, of the pharmaceutical industry, and it's just had a heck of a run recently. You can see here we had a divergent low. The charts work well. I wish they had a sector ETF, and I should have put some of these as official trades, but I've had these as unofficial trades, done very well in some of these, and yeah, I'll get to those in a second. But you can see there the positive divergence right there in place led to this nice rally, and look where it stopped right here. Not by coincidence. This is just beautiful technical analysis on this chart. You had a big old gap right here. You had reaction highs going back for years at that level, at this line, this uppermost line, and a reaction high right there. And we went, and that's where we are today. So I think it's time to rein in some profits on these guys, if you caught any. And look at this also, nice. Look at that bull flag continuation pattern right smack in the middle of that run right there. Again, this is about 5 different great examples of technical analysis on this chart. But again, time to probably reel in some profits. The names, for example, ENDP was one that I've harped on in recent weeks in the trading room, and this thing's rallied about 44% in just the last couple weeks, and it's coming right up here to this target. Remember, this was an official trade we had back on all the way back here. The first target was hit. They barely ran our stops. Story of my life recently, and it went on to play out. But I started picking up on it again. It was looking good here, and right now you can see this. If you're in this one, we are coming up to what was before, and in the trading room I mentioned these 3 targets would be the next targets on the next run. So I think we're going to get a pullback here. Like I said, the sector's at support. It's had a pretty extended run, and this stock alone, not only does it align with sector resistance, but we can see pretty decent resistance on the stock. That's the NDP. A couple of you in the trading room mentioned TEVA, and this one looks pretty good right now. Or it was looking good. I mentioned the other day, yes, it took out this level. My last update, or a couple, I shouldn't say my last update, but back here, I pointed out it was overbought, under 7% rally in this trend line. Watch out for a break of that trend line. And we did. We broke that trend line, went down, had a heck of a correction in that stock, but since powered back up, and I had this uptrend line here we took out. Now, where I'm going with this one, because I know a couple of you in the trading room are either in this or follow this one, we now have divergence as well forming here, maybe a little bit right there, but we're overbought. You can see these circles. Last time we were overbought right here. here, here. What happened after that point? Well, we'll measure it out here in a second, but you can see the 4 times in the past 2 years we've been overbought. The previous three we had a drop, well, from high to low, that drop was 82%. If you want to just play the game of from this drop down to here, that was a 50, still 50% or so. From this point here, we had a drop of 67%. So you get the picture here. Even this last one, I have to go to the edge of the screen. That was about a 28, 30% drop. So once again, we're overbought. And I did make mention the other day, it looked good because it took this level out, but now I'm revising my analysis with the sectored analysis. This is a component of that specialty and generic drug manufacturing sector. There is a thin zone right here. I'm going to point that out. You know, if the sector can take out that resistance, and that is always a possibility, I just play the odds. And the odds say a pullback here, but this is a thin zone. You can probably see it here on the volume at price histogram. I can just look at the chart without the volume at price histogram on and tell you that that's a thin zone because you can see very few trades. What I mean by thin zone, it's comparable to a gap. See the volume at price histogram here? You have all these big red and green bars here, a bunch down here, nothing here, and that's because very few trades occurred in between there. So that works very similar to a gap. There was a big gap there, but there was a candle in between, but that was only one day's trading action. So that really is not significant in the bigger picture of things. So that's the outlook for Teva. If you're in this one and you want to trail a stop, or maybe look to position on a back test that trend line, that may work. I'm playing the odds, and I think it's probably best to take profits on this one or tighten stops up. You can tighten stops up. There's a minor trend line here you can draw, and again, that 22.58 level should act as support, maybe a little bit below there. Call it 22, somewhere around here. Put a line there. I don't know what that is, so I'd have to, here, I'll give it to you right now, and then we'll wrap this video up. Yeah, about $22. That stock should remain above 22 or it won't look good, and also keep an eye on the sector. That is it, guys. If anything else stands out, I'll let you know, but I'm keeping it light this week and may look to re-engage this market tomorrow, Friday, or early next week, depending on what happens. Let's just see the shakeout after the FOMC announcement and how the charts develop. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.